Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. This week on the podcast, Phil, we got an email question that came in for someone asking a question about selling an inherited home, right? The tax fear a lot of times that people have just through an inheritance or just getting something. So I thought we would take this question and just kind of see if we can give some, some ideas, some things to think about. Okay, so let me break this down for you here. This was the question that came in. Mom passed away a couple years ago. My 3 sisters and I inherited her home. I've always wanted to sell it. They're just now coming around to the idea, but now they're worried about the tax implications. So I keep telling them that I don't think it's going to really hurt us too bad from a tax perspective, but I don't really have the skill set to understand or to explain why, Can you please help? So can you kind of break down like what happens when you get a home, an inheritance and how that kind of works for folks?
Yeah. And it's often a fear of you're thinking, well, hey, I know mom and dad, they only paid $20,000 for this house 40 years ago.
Right.
And now it just sold for $400,000. I can't afford to pay taxes on $380,000.
Right.
What's it going to be for us? So the reality is if you inherit a house through somebody's estate, right? So you've inherited a house, it's passed through somebody's estate. Then the beneficiaries, the recipients of that house get what's called a step up in basis.
Right. Meaning
that their basis is the current value on the date that individual passed away.
So we'll go with your 400,000 example.
So let's say, right, that even though she only paid, 20 for it, it was worth 400,000 when they passed away.
Yeah.
So that becomes the beneficiary's cost basis.
Right.
So if they turn around and sell it right away, well, then chances are they're not going to have any gain or very little.
Right.
Gain.
So if they sold it for 410,000, they'd only be paying taxes on 10,000.
Then they get taxes on 10,000. Okay. So it's whatever the difference is between that value going forward.
Gotcha.
In the reality is most of the time, even in that scenario, you don't have a loss because there's now a cost of sale, right? So when you sell a house, you have commissions and transfer and transfer taxes, title, all these different things that are generally around a 10%, 6 to 10%.
Okay.
So if you sold it for 4, you probably only got 360, but your basis is still 4. So you might actually have a $40,000 loss.
Which they would then divide amongst the 3 of them.
You can get a tax deduction potentially on their return.
Okay.
So yeah, from their standpoint, it's not a problem. And this comes up very often. In fact, it's pretty timely. I'm working with a client right now whose father just passed away last September. Has a condo down in Florida. Had it for years. So, Florida real estate has gone just crazy in the last few years. It's kind of cooled off over the last year. But yeah, if they were to sell that property based on the cost basis, there could be a substantial gain.
Okay.
But for them, everything gets revalued on the date that individual passed away.
Gotcha.
So at a high level, that's how it works. So here, though, becomes all the technicalities and things you got to start looking at. So in a perfect world, what should happen when somebody passes is you should get an appraisal at that point. So you can kind of set the in stone, here's what the number is. You've got some documentation to determine this is what the value was at that point in time.
Okay.
Most of the time that doesn't happen. Usually like with this client, and I knew around that time, so we had already had this discussion. But a lot of times it'll come up, 3, 6, 9 months later when they're selling the house. So what do you do then? Well, a couple of options I'd recommend. Talk to the realtor that you're working with and see if they can do a market appraisal. It's not going to be an official appraisal, but like they would for listings, but using homes that sold around that time frame, because all that data is there. So if you were to sell your house today, they're going to come back and give you a market valuation based on current listings and sales today to give you approximate valuation. Well, they can do that same thing and just backdate it because all the data is there on what, some homes sold in that time frame around that same residence. So,
okay.
So either do that or, there are some things you can do around. In Michigan, we have taxable value, what's called state equalized value. So SEV, state equalized value, for us is approximately 50% of what the true value is.
Oh, wow. Okay.
So it's kind of a ballpark to give an idea of, what the number could be. So
gotcha.
Or there's ways to manipulate and kind of figure out, do some relationship between what that was and what the actual sales price was compared to what the SEV was then. So anyways, there are ways to do it.
But
that's the way that was to try to get an appraisal so you can set that number.
Right. Yeah. So just for the sake of the education of it, so let's just say somebody does wind up making a small profit or some sort of a profit off the sale. Is that capital gains is what? Probably 15?
Correct. Yeah. So it's long-term capital gains. So that's with any property that's inherited, it's automatically deemed to be long-term capital gain.
Okay.
So even if you inherited it and 3 months later sold it, well, it's still from your standpoint, long-term gain. So any gain you made is going to be taxed at, depending on your rate, could be zero. If you're in the 12% bracket from an ordinary income standpoint,
okay,
more than likely you're probably going to be in the 15% capital gain rate plus whatever your state is.
Gotcha.
So
now the fact that we were just talking, I was thinking about this. She did say that it was 2 years since the mom passed. Right. So the value could have gone up. So they could have some capital gains going on.
So in their case, exactly. I mean, so their scenarios, unfortunately, pretty typical, right? It's
sure
they tried to decide what they're going to do. They finally figured it out. Well, now they're realizing, I should have had an appraisal. No way you're going to get an appraisal. So talk to a realtor, see if they're able to do it or willing to do it for you, because they can get the data and do it. So there are ways to figure out and
to find out what it was 2 years ago.
Right.
I gotcha.
Right.
Okay.
Yeah. I mean, at the end of the day, you just need some justification as to why you're picking that number. You can't just arbitrarily say, I think it's worth, 400,000.
Gotcha.
If it ever comes up in an audit, the IRS decides to look at that return, you're going to have some justification as to why you said it was worth that value.
Okay.
And as long as you've got a reasonable calculation as to why you've done what you've done,
yeah,
they're not going to argue with it because they don't know. They don't have any other, what are they going to do? They can't.
Right.
So, okay, you tell me what you think it's worth and tell me what you're, how you come up with your number, and we'll have a discussion.
So it is pretty typical for people to sit on it a little bit and then maybe, maybe kind of have this issue. So a little bit of homework obviously sounds like it might need to be the case. Does the multiple sisters does that play into it, or you just kind of, I imagine just splitting that equally?
Yes. I mean, it really depends on how the house is titled. I mean, if it was in a trust, then this is all happening at the trust level, which is, for my client's case, is happening. So when they sell it, the trust recognizes the gain, but then it makes distributions to beneficiaries. So then all the beneficiaries get a Schedule K-1 from the trust that report their portion of that gain.
Gotcha. Okay.
If it's, literally all of the sisters' names are on the house, they're all on the title, well, then that closing, it's the title company is going to issue a 1099-S for the sale of the property to each of the individual siblings. And then they're each going to be responsible for reporting. And I've seen it that way too. The biggest thing there is just make sure that you're kind of together on what is our cost basis. Everyone's doing the same thing, so that everyone's following the same path.
Right. So. Yeah. All right, so that's kind of a high level tax, rundown of that. And again, of course, seek consultation from a team, get some help, right? Talk to a realtor, talk to a financial advisor. Should this be happening to you? What are some non-tax issues, Phil? Anything to kind of think about there you've seen through the years when families get a house inheritance?
Yes, and again, back to the client I'm working with now, one of the biggest issues with retaining the house is, okay, well, who's going to pay for the property taxes, the utilities, the insurance, the roof needs to be done. Maintenance, all these it costs money to keep a house.
Yeah.
And that's always the challenge. Everyone wants, you can't sell mom's house, but, you know what, the water bill just came in, and, hey, we need to replace the roof because she never replaced it. Now it's leaking.
That's true, right?
25 grand. Who's going to pay for, I don't have that money. It's like, okay.
Yeah, that's true, right? So you've had multiple kids. You got somebody going, I've got this emotional attachment. We need to hang on to it until maybe, thing gets a little sticky with some of the costs. That's true. And then maybe to the point of 2 years later, that may have been what happened here because it took them a while to come around to the idea. Right. It's like, it's too expensive to keep it. We should just sell it. So, okay.
Right.
Yeah, that's good stuff.
Yeah. And that is always the challenge with a house left like that.
Mm-hmm.
Because I'll have scenarios where clients even will have like a second home. Maybe they got a lake home And, oh, it's been something our family's enjoyed all our life. And we want to make sure it stays there for our kids and grandkids.
Right.
That's great. So there's a process we can do to make sure it has viability. So let's set up a separate trust for it.
Okay.
Put the house in the trust, but you can't just put the house in the trust. You now have to put some money in the trust that is, figure out how much does it take to maintain this house over how many years do you want it to be there? 20 years? Okay. So how much is it going to take to maintain this property over 20 years? So make sure there's enough money in that trust to fund the maintenance and upkeep of that property over that time. Otherwise, at some point, it's just going to become a burden and, frankly, probably a point of dissension amongst the kids, because one of them is going to say, we can't get rid of it. Mom and Dad wanted us to maintain it. And the other one's like, well, you're the one that stays there all the time. I mean, it's just.
Yeah. That's a great point, though, Phil. That's a great way of looking at that, right? So if you have the resources and you have something like that, take some of that strife off the table by building that kind of trust in place and kind of funding that up. That's a great way of looking at it. But if not, then maybe that discussion while you're still here is, why don't we sell that, know?
And have that discussion with the kids to say, hey, look, this is what we're thinking. What are your opinions on it? Be more open with that. Don't leave it to them later on, because that just creates a lot of potential strife later.
Okay.
And if in that scenario, maybe one of them is like, I really, I would like to maintain it because we do have some memories there and I like it.
Yeah.
And if the other ones don't, well, then maybe you segregate the estate. It doesn't have to be, there's 3 siblings and everyone gets a third of everything.
Right.
Well, no, I mean, the one could get the house, maybe the lake house, and the others get more of the other assets, as long as, division happens according to what you want. It doesn't have to be a third of, all the assets, the same with all of them. So,
depends on your siblings, I guess. So,
yeah, exactly. But again, the more of that you can work out ahead of time, the better off it is later on, because too often I see this happening where there's strife and dissension amongst the siblings, feelings get hurt, people don't talk to each other for years. I've seen families split over stuff like this, and then attorneys get involved, and all of a sudden now there's thousands being spent on attorneys. It can be a mess.
I say all the time, money makes people funny when it comes to inheritances, right?
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of The Tax Smart Retiree right now.
Inherited property, it feels complicated, and maybe sometimes it is, but it's not always too complex.
There's some moving parts.
But once families, I think, understand the tax rules, right, that kind of helps things out. So I think the big takeaway here is that step up in basis for a lot of people. I think that's usually the initial kind of, oh my gosh, mom and dad paid $100,000 for it or whatever, and now it's worth $1 million, and we're going to get hammered, So that step up in basis, but that's really good. Point there is, the sooner you can move on things when they pass and leave it to you, the better, because now you've got to deal with a little bit of extra paperwork, especially if you go years before you try to sell it. And just real fast, the final piece, Phil, on that. It's important that she did leave that to them after she passed, because had she given that to them beforehand, you lose the step up, right?
Well, and so that's another great point. If you, and a lot of times people do the easy estate planning. I'll just put their name on the house.
Yeah.
Okay. So legally, what happened at that point is it was a gift.
Yeah.
At the point that they put their name on the house, the kids' names on the house, it now became a gift.
While you're still here.
And that's a different set of rules.
Yeah.
So gifting rules is not a step up in basis, it's a transfer basis. So now, to your point, if it was $100,000 they paid and it's worth $1 million, well, they don't get the $1 million step up.
You just
they get $100,000.
You just hammered them with taxes, right? Yeah. You maybe thought you were, as a parent, you maybe thought you were doing a good thing by them, but you actually just made it way worse, right? So after death is the best way to transfer. Yeah.
So the ways to do that are, if you don't have like a trust, then use, in Michigan, we have something called a ladybird deed. And again, so this isn't legal advice, talk to an attorney.
Right.
But in Michigan, we have what's called a ladybird deed, which is effectively like putting a beneficiary on the house. So you haven't given it to them. Technically, their name isn't on the property. The other, back it for just a second on that, the other challenge with that is, so you're thinking you're trying to avoid probate, right? That's generally the concept. Put the kids' names on the house because you don't want it to go to probate and you want it to go to them. Great. What happens if one of them gets in a car accident and kills somebody?
Yeah.
And now they get sued. Well, their name is on your house, and your house is now part of that.
What happens if one of them gets divorced while you're still here?
Or one of them gets divorced. Yeah, it's just creates, because it's their asset now.
It's their asset, yeah.
So ladybird deed avoids that because it's not theirs. They're just a beneficiary when you pass, or setting up like a trust is another way, because now the trust owns it. The trust can get the step up in basis, but then ultimately they're the beneficiaries of the trust. So there's several ways around that process, but yeah, you're absolutely right. You want to make sure that you do it the right way. Just joint ownership. Yeah. You're not going to get that step up in basis.
So some nuances there, folks, to think about, especially if this is possibly going to happen for you or to you, or you're leaving something to the kids or whatever. Certainly understand some of the rules. Talk with a financial professional while you're still here, or if mom or dad happen to just pass away and they left you something. Try as soon as possible to get things rolling so that you can kind of get this data going. If you need some help, as always, reach out to Phil. We'll have links in the show descriptions below. You can find him online at philstaxhacks.com, but just click on one of the links below and get started with a conversation. But talk with somebody. Certainly reach out to somebody and get started. Thanks so much for checking out the podcast. We always appreciate it. Subscribe to us on Apple or Spotify or right here on YouTube. If you got a comment or question, leave it down below as well. Engage with us, chat with us here on the channel. Certainly helps things out, and hopefully we provide you with some useful nuggets of information to help you along the way with finances and retirement, because it can get a little sticky out there. So with that, thanks so much for your time. We appreciate it. Phil, thanks for breaking it down, buddy.
Not a problem. Take care.
We'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.